All of this European debt concern has the dollar up against the euro. Joining us now for more on this, Stephen Englander, Director and Global Head of G10 FX Strategy at Citigroup. He was the Chief FX Strategist at Barclays Capital and Head of Domestic Research at the New York Fed. Stephen, welcome to Bloomberg. Always good to have you on. Thanks so much. I know you were on the radio today with my colleague Tom Keene. Let's get right to it. A little bit of disappointment about what was going on in Europe today. Is there no broad stroke picture here that's going on?
I think that's very much the issue, that you had a summit. The market kind of knew that there was nothing much on the agenda that would solve the immediate problems, but they were hoping for more, some indication that a more comprehensive solution was coming. And if anything, as Dominique Strauss-Kahn did, the speakers after that meeting were throwing cold water on anything near term with respect to a broader solution.
Why do you suppose that is? Because here in the U.S. we use the term kicking the can down the road. Is that what they seem to be doing here? Well,
I mean, the problem isn't kicking the can down the road. You have to kick it down the road effectively. And if you take a look at two-year yields in Europe, they're still very high. So even the countries have received packages. Markets don't really believe that they're going to get through the next 2 or 3 years. Otherwise, rates would be a lot lower. So what they have to do is convince the markets that, even in this kind of medium term, there's no default risk, and so far they haven't been able to do that.
Stephen, what's the significance of this cut by Moody's and Ireland's debt?
Well, in terms of the market, that was already priced in, pretty much. I mean, you saw Irish debt widen a little bit. You saw the euro drop a tiny bit. That wasn't the issue. The issue really is, are you going to be able to convince the markets that, as Dominique Strauss-Kahn said, you're going to have the growth that will enable you to get out of this? And right now, the markets are very unconvinced.
We see the dollar reaching the strongest against the euro in about, half a month now. Does that play hand in hand with what we see going on in Europe right now, specifically these folks meeting today?
Very much so. I mean, when we see the dollar strengthen like this, it's usually a reflection of tail risk in the eurozone. The markets like what the Europeans want to do in terms of fiscal policy. They like what the Europeans want to do in terms of monetary policy, but they're afraid that it's not going to fit together, that's not going to work out, and that there will be some sort of fiscal rupture. And every time that probability goes up, the euro sells off.
Any concerns that the dollar's not at least a bit stronger right now?
QE2 weighs on the dollar. I think had these exact events been playing out 6 months ago, we would have been closer to 120, 125. I think the QE2 issue is something that makes global central banks, reserve managers reluctant to hold dollars, even if the euro is carrying a lot of risk.
Stephen, can I ask you, with what's going on in the eurozone, because we've been hearing a lot about Ireland, we're hearing a lot about Greece, now we're hearing whispers about Spain. Is Germany the linchpin in here? Because they were the one, Angela Merkel was the one who effectively said, okay, we will help you out. Does Germany take a hit because of that?
Well, if the euro falls apart, Germany will take a big hit. And if there's a debt restructuring among a sovereign, all of European banks will take a big hit, including German banks. They're trading along with the rest of European banks as well, so clearly they're at risk. I mean, the question is, I think there's a political question in Europe, within Germany. How willing is the population to help bail out the other countries? And in the other countries, is how willing are they to take pain in order to, preserve the euro?
Stephen, could I ask you just quickly, back here in the U.S., we're going to see President Obama sign this tax bill into law this afternoon. Is there a significance on that, on how that's affecting the markets and perhaps affecting currencies as well? Was there some sort of stabilizing factor that said they finally got a deal done? It might not be the best deal, but it is a deal?
Very short-term reaction. I think the market likes it, but if the U.S. was in the eurozone, it would be somewhere around Ireland and Portugal in line for a bailout, given the fiscal number, the deficit, and given the debt.
Wow. Stephen Englander joining us here on set today. Stephen, always good to have you on. Thanks so much. Appreciate it. Stephen doing double duty today on radio and on TV. Thanks so much. Appreciate it.